Before we start, this is exactly what we're going to talk about in this video. You see this thumbnail? Warren Buffett holding up 5 fingers because there are 5 keys to success in his story from zero to hero. These aren't some random principles we made up. These are the actual tactics, the specific moves, and the psychological mastery that Warren Buffett used. It is the winter of 1939. The world is on the brink of war, but in the backyard of a house in Omaha, Nebraska, a little boy is playing in the cold. He is catching snowflakes, first one at a time. Then he starts scooping them up by the handful. He packs them tight. He packs them into a small, perfect ball. He places it on the ground. He gives it a slow push. It rolls. It picks up more snow. The surface area expands. He pushes it across the lawn, and with every rotation, the ball gets heavier. It gets bigger. He reaches the edge of the yard, but he doesn't stop. He hesitates for just a second, and then he heads off, rolling this growing snowball through the neighborhood. He is casting his eye on a whole world full of snow. This is the perfect metaphor for what we are about to explore. Warren Buffett's life is not about a sudden explosion of wealth. It is not about a lottery ticket or a lucky break. It is about the physics of accumulation. It is about the snowball, a small, damp sphere, wet and sticky, rolling down a very long hill for a very long time. The man sitting in an office in Omaha in 2025 controls over $750 billion. He is the richest man in the world. But he didn't get here because he was smarter than everyone else. He got here because he understood something that most people never grasp. Compound interest is the 8th wonder of the world. Today, we are not just reading a biography. We are deconstructing the operating system of the greatest capitalist in American history. We are going to see how a boy who was shy, awkward, and obsessed with numbers hacked the code of capitalism. We are going to look at the financial moves, the specific deals, and the psychological mastery that turned a few $1,000s into $100 billion. This is the blueprint of Warren Buffett. Let's dig in. To understand Warren, you have to understand the environment that forged him. He wasn't born into poverty, but he was born into the shadow of the Great Depression. He was born in 1930, just months after the stock market crash that decimated the American economy. His father, Howard Buffett, was a stockbroker, but he was no ordinary stockbroker. Howard was a man of intense integrity, a rigid moral code, and a deep skepticism of government overreach. He had survived the Depression. He understood that money was a tool, not a goal. Warren idolized his father. He would hang around his father's brokerage office, chalking the stock prices on the big blackboard. He loved the noise of the ticker. He loved the paper. He loved the numbers. While other kids were playing tag or dreaming of becoming baseball players, Warren was dreaming of numbers. He was fascinated by them. He didn't just see them as digits. He saw them as a way to organize the chaos of the world. He would sit on the porch of his house on 53rd Street and watch the traffic go by. But he wasn't just watching cars, he was recording them. He would fill notebooks with the license plate numbers of every car that passed. He would tally them up. He would calculate the frequency of the letters and the counties. He wanted to know the probabilities. He wanted to own the data. This obsession with data, with patterns, with probability, would become the foundation of his entire life's work. When he was a little older, he and his friend Russ would hang out at the local golf course. But they weren't there to play, they were there to work. They would search the rough and the ponds for lost golf balls. They'd clean them up, sort them by brand, Titleist, Spalding, and sell them back to the golfers. It was pure arbitrage, free inventory, a little bit of labor, and a markup. He was 6 years old, and he was already understanding the fundamental principle of capitalism. Buy low, sell high. The money he made, he didn't spend, he saved it. He saved every penny. At age 11, Warren made his first real investment. He had saved up $114.75 from selling gum, coke, and golf balls. In today's money, that was approximately $1,800, a fortune for a kid. He convinced his sister, Doris, to join him. They bought 3 shares of a company called Cities Service Preferred at $38 per share. Now imagine the tension. An 11-year-old boy, his entire life savings on the line. He watches the ticker. He reads the numbers every single day. He can't sleep. He can't think about anything else. The stock drops. It goes to $27. He's lost nearly a third of his net worth in a matter of days. He feels sick. He feels the pressure of his sister's money on his shoulders. He is terrified. This is the first emotional test of his life. Then the stock bounces back. It climbs. It hits $40. Warren breathes a sigh of relief. He wants out. He wants to secure the win. He wants to be safe. He sells the shares, netting a profit of $5 after commissions, a total of $5. He feels smart. He feels relieved. He feels like a genius. But then he watches. City Service Preferred keeps climbing. It goes to 50, then 100, then 150, then 200. If he had held on, he would have made hundreds of dollars. Instead, he made 5. This moment was seared into his brain like a cattle brand. It was his first tuition payment to the School of Market Reality. He learned 3 things that would define the next 80 years of his life. First, don't fixate on the price you paid. Your entry point doesn't matter if the business is getting better. The price you buy at is irrelevant. The future cash flows are everything. Second, don't sell just to grab a tiny profit. The worst thing you can do is turn a long-term investment into a trading decision. The moment you sell, you cap your upside. The moment you buy, the entire future is in front of you. Third, patience is not just a virtue, it is a financial instrument. Time is the friend of the wonderful business and the enemy of the mediocre one. If you can be patient, you can be rich. If you can't, you can't. If you look at his later career, holding Coca-Cola for 30 years, holding GEICO for 40 years, holding Apple for over a decade, it all goes back to that mistake with Cities Service. He realized that the real money isn't in the trading, it's in the waiting. In 1942, his father was elected to Congress. The family moved from the quiet, familiar streets of Omaha to the bustling political atmosphere of Washington, D.C. Warren hated it. He was lonely. He missed his friends. He missed Nebraska. But instead of wallowing, he did what he always did. He channeled all that frustration into business. He became the most aggressive paperboy in Washington. This wasn't a cute little route where he tossed a few papers on porches. This was a logistics operation. He delivered the Washington Post and the Times-Herald. He figured out that if he combined routes in the same apartment complexes, he could deliver hundreds of papers in a fraction of the time. He woke up at 4:30 in the morning every day. While his classmates were sleeping, Warren was building capital. He had a system. He knew exactly which customers paid on time and which ones he had to chase. He memorized the expiration dates of subscriptions so he could upsell renewals. He wasn't just delivering papers, he was running a business. By the time he was a teenager, he was making $175 a month. That was more than most full-time adults were earning in the 1940s. He was making more money than his teachers.
He saved every penny. He didn't buy cars. He didn't buy fancy clothes. He bought assets. At age 15, he spent $1,200 to buy a 40-acre farm in Nebraska. He rented it out to a tenant farmer. Think about that. He is sitting in a classroom in D.C., bored out of his mind, listening to a teacher drone on about algebra, and in the back of his head, he knows he's a landowner. He has a tenant working his soil 1,000 miles away, generating cash flow while he takes a nap. This is the zero-to-hero mindset in its purest form. It's not about waiting for permission. It's about asset accumulation. It's about understanding that money doesn't have to come from your salary. Money can come from your assets. But the masterstroke of his teenage years was the pinball business. This is one of the best stories in the Buffett lore because it shows his ability to spot an inefficiency in the market. It shows his entrepreneurial instinct. Warren and his friend Don Danley were looking for a new hustle. Warren saw that the local barber shops in Washington were filled with men waiting for haircuts. They were bored. They had loose change. They were looking for a distraction. He found an old, broken-down pinball machine. He bought it for $25. He fixed it up. He went to a barber and said, "I'll put this machine in the back. It costs you nothing. We split the profits 50-50. The barber agreed. The first night, they came back to check the coin box. It was full.
Warren didn't take the money and spend it on milkshakes or toys. He took the money and bought another machine, then another, then another. They called it the Wilson Coin-Operated Machine Company. They created a fictional boss named Mr. Wilson, so that when people complained or wanted a deal, Warren could say, "Gee, I'd love to help, but Mr. Wilson is really tough on these things." It was genius. Warren had created a scapegoat. He was learning the psychology of negotiation without even realizing it. Soon, they had machines in barber shops all over Washington. They were making $50 a week, which in the 1940s was real money. Warren was a tycoon in high school. When he finally graduated, he sold the business for $1,200. He had turned a $25 investment into a multi-thousand-dollar empire, plus months of weekly cash flow. This is the pattern that would repeat for the rest of his life. Find an inefficiency, exploit it, reinvest the profits, repeat. After high school, Warren moved through different opportunities, each one teaching him a lesson about capital allocation and business operations. He worked at various jobs, but his mind was always on investing. What Warren understood that most people didn't was that his job was just a means to an end. The end was capital accumulation. The job was the tool. He saved aggressively from every position he held. He read everything. He read annual reports. He read newspapers. He read investing books. He became obsessed with understanding how businesses worked. He wasn't interested in theory. He was interested in reality. He wanted to know how companies actually made money. He studied the great investors. He read about them. He analyzed their investments. He was building his framework. And then he found Benjamin Graham. Graham's philosophy was simple but revolutionary.
A stock is not a piece of paper. It is a piece of a business, and you should only buy that business if you can get it for less than it is worth. Graham called it buying a dollar for 50 cents. He called it the cigar butt approach. You find a cigar on the street that is soggy and gross, but it has one good puff left in it. It's free. You pick it up, take the puff, and it's pure profit. This philosophy changed Warren's life. It gave him a framework. It gave him a way to think about the market. But Warren didn't just accept Graham's philosophy. He took it a step further. He added his own insights. He combined Graham's value approach with an obsession with business quality. Through his study of Benjamin Graham's work, Warren learned that Graham was the chairman of a small insurance company called GEICO. Warren had never heard of it. But if Graham was involved, he wanted to understand why. He arranged to meet with an executive at GEICO. The meeting was supposed to be brief, maybe 15 minutes of Warren asking questions, but something magical happened in that conversation. The executive realized that this young man wasn't just asking questions, he was thinking like an analyst. He was asking about loss ratios, about underwriting discipline, about float. The conversation lasted 4 hours.
During that meeting, Warren had an epiphany. He realized that insurance wasn't just a boring business with actuarial tables and claims. It was a machine for generating cash. Here's how it works. Insurance companies collect premiums up front. They invest that money immediately. Then they pay out claims later. In the meantime, the money is working for them. It's compounding. They're using other people's money to generate returns. This money, the premiums that come in before claims are paid out, is called float. Warren realized that if he could own an insurance company, he would have a permanent source of free capital to invest. He wouldn't need to borrow money from banks at interest. He would use the policyholders' money. It was a game changer. This insight would become the foundation of Berkshire Hathaway. It would become the engine that powered the snowball. He put a massive portion of his net worth into GEICO stock. People thought he was crazy, but he had done the work. He had looked under the hood. He knew something they didn't. After working in various roles, Warren returned to Omaha in 1956 with approximately $174,000 in savings, roughly $1.7 million in today's money. He could have retired. He could have lived a comfortable life. He could have stopped right there. But the snowball was still too small. He rented a house. He didn't get a fancy office. He worked out of his bedroom. He bought a few pieces of furniture. He got a phone. He got some paper. He invited 7 family members and friends to a meeting. He told them he was starting a partnership. He wasn't going to tell them what he was buying. He wasn't going to give them daily updates. He asked for their money and their absolute trust. He put in $100 of his own money, just $100, and the Buffett Partnership Limited was born. This was the moment the rocket ship left the launch pad. This was the moment the boy became the businessman. Warren sat in his bedroom poring over Moody's manuals, giant books filled with the financial data of thousands of companies. He turned the pages one by one. He didn't use a computer. They didn't exist yet. He used his eyes and his brain. He was looking for anomalies. He was looking for mistakes. He was looking for companies that the market had mispriced. And he found them. He found companies that were trading for less than the cash they had in the bank. He found companies that no one else wanted. He found the cigar butts that Graham had taught him to find. One of those companies was a dying textile manufacturer in New England called Berkshire Hathaway. It was a miserable business. It had dusty mills. It had high energy costs. It had competition from cheap labor overseas. It was losing money every quarter. But Warren noticed something. Every time the company closed a mill and sold off the looms, they used the cash to buy back their own stock. This drove the stock price up slightly. It was a temporary boost. Warren figured he could buy the stock at a low price, wait for the next mill closure, and sell it back to the company for a quick profit. It was a classic cigar butt play. He started buying shares. He bought thousands of shares.
The CEO of Berkshire, a man named Seabury Stanton, noticed. He called Warren. He asked, "What's your price?" Warren said, "I'll sell at $11.50 a share." Stanton agreed. He sent out a tender offer to all shareholders. But when Warren received the official offer in the mail, he saw the price, $11.37.50. Stanton had tried to chisel him out of 12.5 cents per share. Most people would have shrugged. It was just pennies. It was nothing. But Warren Buffett is not most people. He saw this as a breach of integrity. He saw it as Stanton breaking his word. He was furious. Instead of selling his stock, he started buying. He bought more and more and more. He bought enough to take control of the company. He fired Seabury Stanton. He now owned a failing textile mill. It was, by his own admission, the dumbest stock I ever bought. He had tied up a huge amount of capital in a bad business out of spite. He had let his emotions override his judgment. He had violated his own philosophy. But this mistake became the vessel for his empire. He couldn't fix the textile business. It was structurally broken. The competition was too fierce. The margins were too thin. The future was clear. This business was going to die. So instead of trying to fix it, he used the textile mill's remaining cash flow to buy other things. He bought an insurance company called National Indemnity. Suddenly, the Berkshire Hathaway textile mill was just a shell. Inside, it was becoming a holding company. Inside, it was becoming a treasury for deploying capital into better businesses. Warren had turned a disaster into a fortress. In 1963, something happened that would teach Warren a crucial lesson about markets and human psychology. There was a commodities trader in New Jersey named Tino DeAngelis. Tino was a hustler. He claimed he had massive stockpiles of vegetable oil. He was using this oil as collateral to borrow millions of dollars from banks and financial institutions, including a subsidiary of American Express. Tino would take inspectors to his tank farm in Bayonne, New Jersey. He would climb up the ladder of these giant storage tanks, open the hatch, and show them the oil. The inspectors would dip their sticks in, verify it was oil, and sign off on the loans.
But Tino was a magician. He had figured out how to deceive the system. The tanks were filled with seawater. He had welded a small cylinder inside the top of the tank just under the hatch and filled only that cylinder with salad oil. The rest was water. The inspectors dipped their sticks into the small cylinder and thought they were checking the entire tank. He was floating a few inches of oil on top of millions of gallons of ocean. When the fraud was discovered, it was catastrophic. The financial world went into shock. American Express was on the hook for roughly $60 million. Wall Street panicked. This was a reputation-destroying event. American Express was the gold standard of trust. They were synonymous with safety and security.
If they couldn't spot a guy filling tanks with water, how could you trust them with your traveler's checks? How could you use their card? The stock plummeted. It lost half its value almost overnight. Investors were terrified. Everyone was selling. The smart money was running for the exits. The financial establishment was convinced that American Express was going to collapse. But Warren Buffett was watching, and he was thinking. He didn't look at the scandal the way everyone else did. He didn't focus on the balance sheet damage. Instead, he focused on the customer. He analyzed what this scandal actually meant for the American Express brand. He realized something profound. Yes, the scandal was a B2B problem, business to business. Yes, it was a balance sheet problem, but it was not a brand problem. The scandal was about lending practices and risk management, back office stuff. It wasn't about the consumer product. The average person sitting in a restaurant paying for dinner didn't care about Tino DeAngelis or vegetable oil fraud. They just knew one thing. The American Express green card worked. They still trusted it. They still wanted it. The franchise, the mental real estate American Express owned in the consumer's mind, was completely intact. Warren realized the market was pricing the company as if it were going bankrupt, but the actual engine of profit was perfectly fine. He scraped together every dollar the partnership had. He invested $13 million into American Express. That was 40% of the partnership's total assets. Think about the guts that takes. Think about the psychological strength. 40% of your fund into a company that is currently being sued by everyone on the planet, a company that has just suffered a massive fraud, a company that the entire financial world thinks is going to collapse. But Warren had done the analysis. He knew the numbers. He knew the business. He held his conviction.
The stock rebounded. American Express paid off the debts. The scandal faded from the headlines, and the share price skyrocketed. Warren made a $20 million profit on that single deal. This was the first major sign that Warren was evolving beyond Graham's philosophy. He wasn't just buying cigar butts, dying companies selling below liquidation value. He was buying wonderful businesses that had temporarily tripped. He was buying quality at a discount. But to make this full evolution, he needed a partner. He needed someone to challenge him. He needed someone to tell him he was wrong. Enter Charlie Munger. If Warren is the optimistic, folksy frontman of Berkshire Hathaway, Charlie Munger is the brilliant, grumpy architect in the shadows. If Warren is the storyteller, Charlie is the logician. If Warren is the dreamer, Charlie is the realist. They met at a dinner party in Omaha in 1959. Charlie was a lawyer who had moved to California. He was abrasive. He was intellectual. He didn't suffer fools. He didn't make small talk. He didn't care what other people thought. At dinner, Warren and Charlie started talking. They ignored everyone else. They talked about businesses, about human psychology, about the folly of crowds. They talked about compound interest and capital allocation. They talked about how most people were idiots but didn't know it. By the end of the night, Warren told him, "Law is fine as a hobby, but you can do better." It was the beginning of a 50-year partnership. Charlie was the only person Warren had ever met who could keep up with him. Actually, Charlie was often one step ahead. Charlie would catch mistakes in Warren's reasoning that Warren couldn't see. Charlie had a different philosophy than Ben Graham. Graham taught Warren to buy cheap, to buy fair companies at wonderful prices. Charlie said, "No, that's stupid. You should buy wonderful companies at fair prices." Charlie argued that if you buy a bad business just because it's cheap, you have to sell it as soon as the price goes up. You have to keep finding new deals.
It's a treadmill. But if you buy a great business, one with a moat around it, you can hold it forever. You let the business do the work.
Warren resisted this at first. He loved his bargains. He loved his cigar butts. But then came See's Candies. It is 1972. Warren and Charlie are looking at a chocolate company in California. See's Candies is legendary on the West Coast. It has a fanatical following. People don't just eat See's candy, they give it as gifts. It means something. The asking price was $25 million. Warren looked at the books. The company only had about $8 million in tangible assets. Warren's Ben Graham brain screamed, "Too expensive. You're paying 3 times book value." He almost walked away, but Charlie Munger and a friend named Rick Guerin pushed him. They said, "Warren, look at the brand. Look at the pricing power." They realized that See's could raise the price of a box of chocolates every single year on December 26th, and nobody complained. Nobody switched to a cheaper candy for their wife on Valentine's Day. You don't look cheap on Valentine's Day. That emotional leverage gave See's an economic moat. Warren caved. He brought See's for $25 million. It was the most important purchase of his life. Not because it was the biggest, but because it rewired his brain. Over the next few decades, See's Candies generated nearly $2 billion in pre-tax profits for Berkshire Hathaway. Warren didn't use that money to make more chocolate. He used it to buy other businesses. See's became a gusher of cash that fueled the entire empire. Warren later said, "If we hadn't bought See's, we wouldn't have bought Coca-Cola." So now we have the holy trinity of the Buffett methodology in place. First, the float, using insurance money, other people's money, to invest. Second, the capital allocation, taking profits from one business, textiles, candy, and moving them into better businesses. Third, the moat, buying brands that have a durable competitive advantage. But just as things were heating up, Warren did something that shocked everyone. It is 1969. The stock market is roaring. It's the go-go years. Tech stocks, the 1960s version, are flying. Everyone is making easy money. Warren sends a letter to his partners. He says, essentially, "I don't get it anymore. The market is crazy. I can't find any good deals. I'm folding the tent." He liquidated the Buffett partnership. He gave his partners a choice. You can take your cash, or you can take shares in this weird textile company I own called Berkshire Hathaway. Hathaway. Most people took the cash. They wanted to buy boats or put it into the hot stocks of the day. But the smart ones, the ones who truly trusted him, took the stock. Warren was now the chairman of Berkshire Hathaway. He was no longer a hedge fund manager. He was a CEO. And his timing, once again, was supernatural. Shortly after he closed the partnership, the market crashed. The 1973 to 1974 bear market was brutal. The Nifty 50 stocks collapsed. Panic swept Wall Street. While everyone else was crying, Warren was buying. He felt like a kid in a candy store. Prices were down 50, 60, 70%. He started deploying the capital he had saved. And this leads us to the deal that solidified his status as a media mogul, the Washington Post. Warren had always loved newspapers. He loved the business model. In the 1970s, a newspaper was a monopoly. If you wanted to sell a car or a house in Washington, D.C., you had to advertise in the Post. They could raise ad rates every year, and advertisers had no choice. It was the ultimate toll bridge. The Washington Post Company went public in 1971, but by 1973, the stock had tanked. The market value of the entire company was $80 million. Warren did the math. He calculated that the assets of the company, the printing presses, the buildings, the TV stations, were worth at least $400 million. The market was selling a $400 million bill for $80 million. Warren started buying. He bought nearly 10% of the company. But this wasn't just a stock purchase. This became a personal alliance. The publisher of the Post was Katharine Graham. She was the most powerful woman in American media, but she was insecure. She had inherited the role after her husband's suicide. She was surrounded by men who doubted her. Warren didn't doubt her. He became her mentor. He taught her the business side of the news. He wrote her letters explaining financial ratios. He empowered her to make tough decisions. And a tough decision was coming.
In 1975, the Pressmen's Union went on strike. They smashed the printing presses. They set fire to the equipment. It was violent and ugly. Katharine Graham was terrified. The advisors told her to settle. Warren told her to hold the line. He told her that if she gave in to the union's demands, the business would be crippled forever. He told her she had the capital to withstand a long strike. She held the line. She hired replacement workers. She broke the strike. The profitability of the Washington Post soared. Warren's $10 million investment eventually grew to be worth over $1 billion. But more importantly, this deal put Warren on the map of the establishment. He wasn't just a guy in Omaha anymore. He was sitting on the board of the most influential newspaper in the capital. He was bridging the world of finance and the world of power. Now let's pause and look at the structure he is building here. It's crucial for you to understand this flywheel. Most companies try to grow by doing one thing. Apple sells iPhones. McDonald's sells burgers. Berkshire Hathaway is different. It is a conglomerate, but a specifically engineered one. At the bottom of the pyramid, you have the insurance operations, National Indemnity, GEICO. These companies collect cash, premiums, every day. This cash is the float. Warren takes this float and moves it to the top of the pyramid, the investments. He uses the float to buy wholly owned businesses like See's Candies and later Nebraska Furniture Mart, Buffalo News. These businesses churn out more cash. He takes that cash and buys public stocks like Washington Post, American Express, Coca-Cola. It is a machine that feeds itself. The more cash it generates, the more investments he makes. The more investments he makes, the more cash flows back in. It is the snowball. But now the snowball isn't just rolling down a hill, it has an engine attached to it.
And in the late 1970s and early 1980s, that engine was about to be tested by inflation. The late 70s were a nightmare for the economy. Stagflation, high unemployment, high interest rates. Warren wrote endlessly in his annual letters about the dangers of inflation. He called it a tapeworm that eats up investment returns. He realized that in an inflationary world, you need businesses that don't require a lot of capital to grow. If you own a factory and inflation goes up, you have to spend twice as much to replace your machines. That's bad. But if you own a brand like See's or the Post, you can just raise prices. That's good. This insight saved Berkshire Hathaway while other industrial giants were crumbling. By the early 1980s, Warren was worth hundreds of millions, but he was still relatively unknown to the general public. That was about to change. He was about to make a deal that would be the largest of his career so far, and it would happen in his own backyard, the Nebraska Furniture Mart. This story perfectly encapsulates Warren's handshake style. Rose Blumpkin, known as Mrs. B, was a Russian immigrant who started a furniture store in Omaha with $500. She couldn't read or write English well, but she was a retailing genius. She sold furniture cheaper than anyone else. She worked 7 days a week until she was 100 years old. Warren admired her more than any CEO in America. He said she would run circles around the guys with MBAs. One day he walked into the store and said, "Mrs. B, I want to buy your store." She said, "Okay." Warren asked, "How much?" She said, $60 million. Warren didn't call in the auditors. He didn't do due diligence in the traditional sense. He didn't inventory the sofas. He wrote her a check for $55 million, keeping 10% for her family. He said, "I'd rather have Mrs. B's word than the audits of the big 8 accounting firms." Mrs. B sold the company, banked the check, and was back on the sales floor the next morning selling carpet. This is the zero to hero lesson. Reputation is an asset. Warren could do deals that no one else could do because people knew he wasn't going to gut the company. He wasn't a corporate raider. He was a permanent home for their life's work. Owners sold to Warren because they loved their businesses. They knew if they sold to a private equity firm in New York, the firm would fire the management, load it with debt, and flip it. Warren promised, "I will never sell. I will keep the management. I will let you run it." He became the buyer of last resort for family businesses.
But the 1980s were about to bring a new level of excess to Wall Street. The era of the corporate raider was beginning. Michael Milken, junk bonds, leveraged buyouts. Warren watched this with disgust. He saw companies being torn apart for short-term fees. But he also saw opportunity. He saw that some old-school companies were undervalued because they were scared of the raiders. They needed a white knight, someone to come in, buy a big chunk of stock, and protect them. Warren became the white knight. He did this with Champion International. He did this with Gillette. He did this with Salomon Brothers. Salomon Brothers. Remember that name, because that name almost destroyed everything Warren Buffett had built. It is 1987. Warren invests $700 million into Salomon Brothers, a Wall Street investment bank. It was a departure for him. He usually hated investment banks. They were leveraged, risky, and filled with people who were greedy in a way Warren didn't like. But the deal looked good. He got a 9% dividend. It felt safe. He was wrong. It is August 16, 1991. The phone rings in Omaha. Warren Buffett picks it up. On the other end of the line is a man who sounds like he is drowning. It is John Gutfreund, the CEO of Salomon Brothers. He is the king of Wall Street. He is tough, arrogant, and powerful. But today, he is terrified. He tells Warren, "We have a problem." It turns out a rogue trader at Salomon Brothers named Paul Moser has been submitting illegal bids in the U.S. Treasury bond auctions. He was trying to corner the market. He was faking names. He was breaking the law. That's bad, but what Gutfreund tells Warren next is fatal. He says, "We knew about it months ago, and we didn't tell the regulators." Silence. Warren knows exactly what this means. In the world of finance, lying to the government is not a misdemeanor, it is a death sentence. The U.S. Treasury has the power to ban Salomon Brothers from bidding in government auctions. If they do that, the firm is dead in 24 hours. It will liquidity starve, it will collapse, and it will take Warren's $700 million investment with it. Warren hangs up the phone. He doesn't panic. He goes into crisis mode. He flies to New York. He walks into the Salomon Brothers boardroom. The place is in chaos. Lawyers are screaming. Executives are sweating. Gutfreund resigns. The board looks at Warren. They have no one else. They ask him to take over as interim chairman. Warren accepts. He takes a salary of $1. He is now the CEO of a burning building. On Sunday morning, the Treasury Department calls. They are going to drop the hammer. They are preparing to announce that Salomon is banned from the auction system. Warren gets on the phone with Nicholas Brady, the Treasury Secretary. He begs, he pleads, he uses every ounce of his reputation. He says, essentially, if you do this, you won't just kill Salomon Brothers.
You will trigger a global financial crisis. The entire bond market will seize up. Other firms will collapse in the panic. Give me a chance to clean it up. I will scrub this place with Clorox. I will find every rotten board, burn it, and replace it with good wood. I will take full responsibility. Just give me time. Brady hesitates. He knows Warren. He knows that Warren is a man of his word. He knows that Warren doesn't lie. He knows that if Warren says he can fix this, he probably can. Brady says, "Okay, I'll give you a temporary reprieve. But Warren, the entire world is watching. If we find out there's anything else you've hidden, if there's one more lie, we will not hesitate. We will destroy you and the firm." Warren hangs up. He has saved the firm by a matter of minutes. He has saved the financial system from a cascading collapse. But now he has to face the public. He has to face Congress. He has to restore the reputation of a company that just lied to the government. On September 4th, 1991, Warren sits before a congressional subcommittee. The room is packed. The cameras are flashing. The entire financial world is watching. They want blood. They want to see the billionaire squirm. They want to see him admit defeat. They want to see him apologize and grovel. Warren leans into the microphone. He doesn't read a prepared legal defense. He doesn't use corporate speak. He speaks from the gut, and he delivers the most famous lines in the history of American corporate governance. He says, "I want to say to my employees, if you lose money for the firm, I will be understanding. If you lose a shred of reputation for the firm, I will be ruthless." The room goes silent. He continues, "There is plenty of money to be made in the center of the court. There is no need to play around the edges." The cameras stop flashing for a moment. The congressmen lean back in their chairs. Nobody expected this. They expected excuses. They expected defensive posturing. Instead, they got a moral statement. They got a clear line in the sand. They got a man who understood that reputation is everything. The stock price stabilizes. The regulators back off. The panic subsides. Warren spends the next 9 months cleaning up the mess. He fires the bad actors. He replaces management. He restores the firm's honor. He testifies again before Congress. He answers every question directly. He admits when Solomon was wrong. He explains what he's done to fix it. And slowly, Solomon Brothers returns to normalcy. The Treasury auction ban is lifted after 9 months. The firm survives. The financial system survives. The crisis passes. Warren has saved Solomon, but more importantly, he has proven something that no amount of money could buy. He has proven that integrity is a tangible asset. He has proven that reputation is worth more than billions. He has proven that in the moment of maximum pressure, when everything is falling apart, the man with the strongest character wins.
The stock of Berkshire Hathaway doesn't crash. In fact, it holds steady. Because investors know that Warren Buffett is in charge. They know that he will do the right thing. They know that he will fix the problem. His reputation, built over 50 years of honest dealing, saves his portfolio in 90 minutes. This is the lesson that separates Warren Buffett from every other investor in history. It is not just that he is smart. It is not just that he understands business. It is that he has built an unshakable reputation for integrity. And that reputation, in a moment of crisis, becomes his greatest asset. After the crisis passes, Warren reflects on the experience. He realizes something important.
He realizes that you can lose money and recover. You can lose businesses and start over. But if you lose your reputation, you lose everything. You lose the trust that allows you to operate. You lose the credibility that allows you to negotiate. You lose the platform that allows you to influence. A few months into managing the Solomon crisis, something remarkable happens. While the Treasury scandal is still dominating headlines, Warren is quietly building the largest position of his life. He is buying Coca-Cola stock, and lots of it. The stock market is in turmoil. Solomon Brothers is in scandal. The financial system is shaky. Most investors are hiding in cash. But Warren sees opportunity. He sees a company that is not affected by the chaos. He sees a company that is making the same amount of money whether the headlines are good or bad. He sees Coca-Cola. The stock is down. The market is skeptical. Everyone is worried. But Warren knows something that they don't. He knows that Coca-Cola is not a financial company. It is not affected by Treasury bond fraud. It is a consumer company. It is a machine for making money that is independent of the financial system. He starts buying. He doesn't tell anyone. He just buys. He buys Coca-Cola with the calmness of a man who has just saved the financial system and is now ready to build his greatest masterpiece. This is the nature of Warren Buffett. In the moment of your deepest crisis, when everything is on fire, he is buying. In the moment when everyone is panicking, he is calm. In the moment when others are selling, he is buying. And when it's all over, when the crisis has passed, he is $1 billion richer. The Solomon scandal nearly destroyed him, but it also revealed the true source of his power. It wasn't his intelligence, it wasn't his network, it wasn't his money. It was his reputation. It was the fact that when he spoke, people believed him. When he made a promise, people knew he would keep it. And that reputation, built brick by brick, deal by deal over 50 years, was worth more than all the money in the world. Warren Buffett walked out of that crisis as the most respected businessman in America. He had proven that he could handle the heat. He had proven that when the chips were down, he would do the right thing. And most importantly, he had proven that integrity is not just a nice idea, it is a practical asset that generates returns. So, we have traveled from a boy rolling a snowball in 1939 Omaha to a man sitting in an office in 2025 who controls over $750 billion. We have seen the principles applied, the deals executed, the crises overcome. We have watched him transform a failing textile mill into the greatest holding company in the history of capitalism. We have seen him turn insurance float into a weapon of mass wealth creation. We have watched him buy wonderful businesses at fair prices, hold them forever, and let compound interest do the work. We have seen him survive scandals, navigate recessions, and prosper while others collapsed. The snowball is not small anymore. It is not the size of a basketball or a boulder. It is now the size of a building, and it is still rolling. Warren Buffett proved something that most people refuse to accept. He proved that you do not need to be ruthless to be rich. You do not need to be dishonest to be wealthy. You do not need to cheat to win. You can be patient, honest, and disciplined, and you can still be the richest man in the world. You can sit in a small office in Omaha, Nebraska, and control more wealth than most nations. You can eat the same breakfast every morning and never get tired of it. You can wear an ill-fitting suit and not care what anyone thinks. You can tap dance to work because you love what you do. And you can do it all while maintaining your integrity, your principles,
and your humanity. That is the real lesson of Warren Buffett. The money is just the scorecard. As we close this story, we must ask the final question. What happens when Warren Buffett is gone? What happens to the snowball when the man who rolled it is no longer here? The answer is this: the snowball will keep rolling, because Warren has not just built a business, he has built a system. He has built a culture of discipline, integrity, and rationality that will outlive him. He has trained his successors. He has written his annual letters, which will be studied for centuries. He has proven that the principles work, not because he is a genius, but because they are based on reality. The next generation of investors will read his letters and apply his principles. They will build their own snowballs. They will find their own inefficiencies. They will exploit them, and they will reinvest the profits. The machine will keep running. The culture will persist. And somewhere in the future, there will be another boy or girl who reads about Warren Buffett and decides to start rolling their own snowball. That is the true legacy. That is what will outlast the billions. Because wealth compounds, but so does wisdom. And Warren Buffett has given the world the greatest gift of all. He has shown us the blueprint. He has shown us that it is possible. He has shown us the path. Now it is our turn to walk it. Thank you for watching this deep dive into the life of the greatest investor who ever lived. If you learned something valuable, if you found one nugget of gold in this mountain of content, please like this video, subscribe to the channel, and share this with someone who needs to hear it. Because the snowball is waiting at the top of the hill, and the snow is wet, the hill is long, and the future is yours to build. I'm your host, and I will see you in the next video.